This idea of using gold and stablecoin to kind of reshuffle the deck chairs on the Titanic, debase the dollar significantly, then bring it with the gold valuation, because we've seen from Besant and the Fed papers that came out in August and July, they're slow dripping us, getting us ready for the possibility of a gold revaluation.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for September 15th through September 22nd, 2025, while supplies last. This week, 1 10th-ounce gold maple leaves are just $37.50 over melt per coin. 1 ounce assorted silver bars are just $1.65 over spot per ounce. We also have near historic low premiums on pre-1933 gold. Call us for details. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Matthew Piepenburg from Von Greyerz. Matthew, thank you so much for joining us today.
Well, it's great to be back, Elijah. It's always a pleasure to swap thoughts with you, so this will be good.
Well, it's great to have you, and it's a timely meeting here as we just got a Fed rate cut yesterday. We were recording this on Thursday, September 18th. I wanted to get your perspective on that, and how does this, I guess, play into, we were talking before the interview, how it seems like a lot of things are coming to a head right now. We're seeing really this end of this monetary cycle. We're seeing gold and silver really skyrocket, double in the last couple of years. How does the Fed finally, some people are saying, caving to Trump, or, really lowering interest rates, not being as concerned about inflation, play into all of this?
Yeah, there's so much to pull on, and there's so many themes to start with. But it is the most recent headline. It's worth talking about these rate cuts, which were really so priced in. I mean, the whole market, the whole world saw this rate cut coming, and what really it is. I mean, most listeners probably know it was a 25 basis point rate cut. Again, that was more than 95% of the market saw that coming. It lowers the Fed funds rates to 4 and 25 bips or 4 1/4. So that's what happened. What does it mean? What were confessed? What's the reality behind it? It's a little more interesting. As always with the Fed, what they say, what they're doing, and what's really happening are very, very different things. I think it was, besides just the cut itself and the implications of that, which we can get into, I think some of the things that Powell was saying in the Q&A after were very telling. The one thing is he was using words like trajectory that the Fed is on, which basically in my mind is, a very dovish signal. There could be more cuts to come. So he's building expectations for this. So if we don't cut rates again 2 or 3 times, or at least 2 times this year, the markets will react. It's almost if there was a rate hike. So that was an interesting indication in the Q&A. He's building expectations to stimulate this economy. And he also basically said that 25 basis points won't do it to make the stimulus. So those are kind of some initial reads I got from Powell just in watching his Powell speak or Fed speak. I mean, the official read from the Fed, whether it's Powell or Bernanke or Greenspan or Yellen, the markets and the reactions are so Pavlovian now. Rates are up or down depending on which is a greater threat, inflation or employment or unemployment. So if there's an inflation fear, it's usually rates up. If there's an employment fear, it's usually rates down. And obviously, with the BLS, many people may or may not know, there was a massive downgrade in the non-farm payroll jobs just last week. And it's the greatest downgrade in its history. It was a downward revision of 925,000 jobs. I mean, that's worse than we saw in 2009 after the great financial crisis. So obviously unemployment was Powell's on his mind to justify what is necessary in a labor crisis is a dovish lower rate policy, which is exactly what we got. Again, the reality to me, inflation, deflation, employment, et cetera, rates up or down. The reality, the Fed's real mandate, yes, it's employment and fighting inflation, but its real mandate is a sovereign bond market. And the real question is, do cuts even matter right now? I mean, in a lot of ways, the Fed and what we're seeing, the Fed is a lame duck. Whether we raise rates or not, the T-bill market is still below the Fed funds rate. And short-term T-bills is really the best form of collateral in the markets. There's a massive scramble for T-bills. So one of the things I always have in the back of my mind is how relevant really is this? It certainly is relevant for the markets and it's relevant for politics, but in a certain way, as of now, I'm not even sure I really am worried about whether we go up or down 25 bips. It's really what's the trend going forward. And the trend for Powell going forward is more cuts to come. And that's where it gets interesting. But again, what I think was really more fascinating is what he did after the cuts, because the cuts were relatively, as I said, predictable. Last year, he said that labor resilience was the thing. The whole theme is the labor markets are great. But now with this BLS downward revision, he basically said in his press conference that was a mistake. His old speak was a mistake. And, this 925,000, labor revision, he also said, that's the biggest ever. But he also says we kind of expected this. So my reaction to this, like many others, is, well, what does he mean by that? Were you guessing last year or were you just lying? And since the Fed is all about data dependence, but you're basically saying you don't trust your data. The data is not reliable. He even said about forecasts that they don't really know. So again, what's the point of your data and data dependency if you don't really trust your data, or you're not telling us you trust your data? And what's the point of your forecasts if we don't really know? And the other thing he took a jab, as you mentioned, there's this kind of Cold War between Powell and Trump. Trump has called him a loser, a moron in tweets. That's classic Trump speak. Some people love it. Some people hate it. It's very blunt. But Powell had his own way of basically saying that tariffs are causing some of the price inflation and that the foreigners aren't really, who are exporting to the U.S. aren't reducing their prices. So the American importers are the ones swallowing these higher tariffs, these higher costs. And that's Powell's way of taking a dig at Trump, because if the importers, if the U.S. companies are taking the heat and swallowing the tariffs, that means they're going to have to raise their prices. That's inflationary, and they're going to probably lay off people. That's employment related. So Powell's basically blaming some of the employment and some of the inflation on Trump, which, fine, we can argue about tariffs all day long, and we've done it many times. But what's really disingenuous about that, and I think in Powell's mind, very disingenuous to me, is he's ignoring decades of monetary and fiscal drunk driving by the Fed, by Congress, and by other White Houses before Trump. Bernanke, expanded the balance sheet by $2.5 trillion in 5 years, and Powell did $5 trillion in 18 months. So if you're going to talk about inflation, you want to pick on Trump's tariffs, there's room for that academically, intellectually. But come on, Powell, you're part of this Fed. You're part of this great beast, this creature from Jekyll Island. You are part of the problem for inflation that goes back decades. So I thought that was very disingenuous. But, again, when you're looking at Powell and these kind of lame duck figureheads who have a lot of credibility and a lot of academic credibility and political power, the disconnect between their messaging and their actual power to me is getting more and more obvious. They're becoming less and less effective. Today inflation is in the mid threes. We've been talking about reaching target 2% for years. It's never happened. What's the point of this target? And Powell said in this press conference that we'll probably get to that target 2% inflation rate in 2 years. Well, he said that exact same thing 2 years ago. And of course, we're avoiding the real elephant in the room, that inflation is measured by the Bureau of Labor Statistics, the CPI scale. It is an open lie. It's an open fiction. John Williams and others, and the same scale that Volcker used to measure inflation at 18% in the 80s, that same scale has been modified 22 times since then. But if we use that same scale, we'd have inflation at 10% or 11% right now. And before you just say, okay, great, that's showing how disingenuous or not really blunt Powell is, the bigger issue, besides the CPI scale being a lie and not being able to reach 2% inflation and blaming Trump for the tariffs and not blaming the beast that is the Fed, is the larger issue of what real inflation really means. And that's the biggest disingenuous lie of the whole thing. We're not even talking real data with this data-dependent Fed. We're not even talking real inflation numbers, because if you agree with me and John Williams and the old Volcker scale that we once used, if we have 10% inflation, and we're getting 4% or 5%, or regardless of where you are on the yield curve, from the treasuries to the 30-year, every single U.S. treasury is a negative returning treasury, is a negative returning bond. You're losing 6 to 5% in real terms if you actually look at inflation the way it's meant to be measured, not the dishonest way it's measured now. So getting away from Powell and Trump, just looking at the bond market, the entire bond market is giving you a negative yield. And to me, constructively, when a bond gives you a negative return, that is definition a defaulting bond. So in a lot of ways, the U.S. is already defaulted on its debt. But in terms of this rate cut that kind of ended up, I mean, the markets, what that impact is going to be on the markets, we're all kind of predicting, but it's not that hard to predict. Obviously, with rates coming down, the interest rates going down, it's going to have effect on the dollar, longer term, weaker dollar, longer term, gold at near all-time highs at the announcement. Gold secular going to go higher. I think with more rate cuts to come this year, we'll probably reach 4,000 gold before the end of the year, just because the dollar and the DXY are going to have fluctuations based on this policy move. And even silver, which pulled back a couple bucks, look, it's going to hit 50 soon. That's at least a 20% return just now if you're buying silver. But if you're buying it for the long term, silver's going to go much higher. The GEX is going to go higher. The long end of the yield curve is probably going to see rising yields and bond prices going down. But, the larger question is, the Fed's still effective. And, look, do cuts even work? In 2001, Bush, the DXI went from 108 to 121. The dollar got stronger while Greenspan was slashing rates. So the real question is, at what point does the Fed become less and less powerful? And at what point does the bond market take over natural price discovery? At what point do whatever the Fed does to manipulate rates up or down, or to try and save the U.S. Treasury market, which is its real mandate, at what point did the bond vigilantes come in and bond prices continue to tank? The Fed can't print enough money to support them. Yields spike, and at $37 trillion in debt right now, rising yields will be the coup de grace for the U.S. system. And that's where we're dangerously in trouble. And that's where I think the larger questions of what's really wrong with the U.S. system and this massive implosion moment we're facing, and already in a lot of ways. And I think the rate hike announcement, sure, we got to talk about it, but it reads the larger question of how effective even is the Fed anymore? The political infighting, the blaming on inflation, the back and forth, it's all just smoke and mirrors, because the real problem is we have a debt crisis, and the causes of it are obvious, the consequences are obvious, and the solutions for it aren't that easy.
Right. And I think you mentioned there's so much smoke and mirrors out there right now. And the whole idea that, all our eyes are on the Federal Reserve. I mean, it's kind of like they're tinkering with what money is, right? They're raising interest rates, they're lowering interest rates, they're doing all this, these things, which at the end of the day, money is just gold and silver, and gold and silver are reasserting themselves as money today. What is your take on that? I mean, how this seems to signal that we are at the end of this monetary cycle. We're at the end of dollar hegemony potentially, and that gold and silver really reasserting themselves into the monetary system.
Well, absolutely. This is no coincidence. The DXY is struggling, de-dollarization is happening, and gold is reaching all-time highs. This is nothing new in the cycles of credit cycles throughout history, whether it's ancient Rome, whether it's Weimar Germany, Yugoslavia in the 1990s, France in 1789, the John Law era of 1720. This is nothing new. And we're getting distracted on a lot of different headlines right now. But I think it's important for a couple minutes to put all this into some context, really put this into context, and then you can pull any string you want. But again, these are all things you and I have talked about, Elijah, over the many years. But I think it's time now to just pause and look at this. Look, the elephant in the room is debt. And we've talked about that upside down and backwards. And we all know the debt is extraordinary. The debt to GDP, the 37 trillion and climbing, the deficit ratios, et cetera. We don't need to get into the details. But the problem is debt. And the cause is very simple. In August 15th of 1971, Nixon got off the gold standard. Why? Because we were in debt. He was facing re-election. And when you have a gold anchor to your currency, you can't create more of it. You can't create more debt to pay for it with debased dollars if you've got a gold chaperone. So what did he do? He took away the gold chaperone. Why did he do that? Very simple. It's the self-interest of politicians. Getting elected requires money. Staying elected requires more money. You need to do spending. You need to get popular. You need to get power. Gold was an anchor to preventing you from doing that. By getting off the gold standard, that gave the self-interest of Nixon, like all politicians before and since, more power to create more deficits and then pay for that or monetize that deficit with greater credit expansion and Fed money printing. So that's the philosophical reason. That's the cause. The problem was the debt. The cause was we got off the gold standard, we could do even more debt. So the first consequence of that, again, this is at 30,000 feet. The first consequence of that is clearly currency debasement. And we've seen that since 1971 in empirical objective forms. The second consequence of that debt crisis, that debt cancer, is dishonesty. I mean, dishonesty started the day we got off the gold standard when Nixon said this would be temporary, and don't worry, your dollar will be worth just as much tomorrow as it is today. Well, it's 54 years later. We're still off the gold standard. It wasn't temporary. And measured against gold, your dollar's lost 99% since 1971. The other thing, it wasn't just Nixon in 1971 in August. It was the months before that. The then Fed chairman and the then Treasury Secretary was making the rounds of Congress saying, this gold chaperone, this gold standard is bad for us. In fact, it's holding the dollar back. The dollar's going to get stronger. Of course, that was a lie. And more importantly, they said gold is going to get lower once we get off the gold standard. And since 1971, gold has gone up 8,000% since 1971. So literally every single thing pre and post that policy was dishonest. And not just wrong, I think it was dishonest. And this dishonesty is, again, one of the symptoms of a debt-sick nation. We've seen other forms of dishonesty since then. The modern monetary theory, this idea you can print money, unlimited money, and not have inflation. And we can go into that for hours, but that's clearly a fantasy. That's a lie. The idea that inflation is temporary or transitory, that we can control it like a thermostat, that's been a lie for the last 50 years. Recently in 2022, when we were in a recession, in my opinion, we're still in a recession. We changed the rule of what a recession is. That was a lie. For the last 25 years, the RIA industrial complex and private wealth managers from every major bank have been telling investors that gold is too volatile. That was a lie. It was a deliberate lie. Gold's outperformed the S&P in the last 25 years. So one of the big consequences, not just currency debasement, is dishonesty. And I think the third consequence is really desperation. And we see that in the headlines all over the place right now. The idea, and again, you could pick any one of these threads later, Elijah, but the obvious signs of desperation is that tariffs are going to save us, or that stablecoin is going to save us, or that cutting spending at Doge or USAID is going to save us, or even more terrifying, that AI is going to save us. And even desperate things like the constant talk now of gold revaluation. This asset they once made fun of for decades is now our savior. So those are the signs of desperation. Again, we could spend time on any one of those topics, but the symptoms that the jig is now up, that the lie is up, again, those things are literally everywhere. All things that you and I have talked about and others have talked about, the symptoms are clear. De-dollarization is not a conspiracy theory or a false headline. It's a real force right now. The debate about the dollar and the DXY, which I've had with Henrik Seberg and Brent Johnson, the DXY's moved down, and where it goes from here. These are symptoms that the jig is up. You know, the QE and the stock bubble, the fact that we've inflated the stock market to unfathomable levels, directly correlated to money printing from the Fed. That's just another symbol or symptom that the jig is up. The deformed nature of our credit market. No one is buying U.S. treasuries. That's a reality. Why? Because we're in so much debt, it's less trusted. We weaponize it, it's even less trusted. So that's another symptom that the jig is up. What we've seen in the COMEX, what you and I have talked about, the pure panic on the COMEX, where counterparties want their gold off the COMEX, no longer price fixing gold through levered futures contracts. That's another rabbit hole we could spend hours on. Central bank gold stacking tripled since 2022 because we weaponized the dollar. That's an obvious U.S. Treasury replacement. Gold is clearly the new central kind of strategic reserve asset for the world. We saw the trend of dumping treasuries and buying gold since 2014. The world's been net stacking gold, net dumping treasuries. It's just accelerated. So that's another sign. The petrodollar, 20% of oil being sold outside the U.S. dollar. That was unthinkable 5 years ago. These are symptoms, again, that the jig is up. Even Judy Shelton talking about a gold-backed treasury at the long end of the curve. That's not a confession of American strength. That's a confession that the American dollar and the U.S. Treasury isn't going to be trusted unless there's gold in it. So again, these things are all symptoms of those consequences, the dishonesty and the desperation, which is no longer working. And I think that God knows the global relations, Trump or no Trump, tariff or no tariff, they're the worst since 1949. Militarily, we have the biggest risk of nuclear war since the Cuban Missile Crisis. Within the U.S., the polarization left and right is murderous, literally on the headlines now. It's so violent. I see the same thing in Europe with coalition governments and the complete disconnect between the people and the leadership and the infighting socially and culturally. So those are all signs academically, historically, that I've been tracking now for 5 years that are really coming to roost now. And in terms of solutions, whether there's going to be no easy solution, whether we have some kind of global reset, Bretton Woods 2.0 or a Plaza Accords, what we first need is honesty. Somebody has to get up and say, we are past the Rubicon of growing our way out of this debt. With 120, 125% debt to GDP, mathematically debt stops you from growing. It slows growth by a third. That's just basic math and history. So we're not going to be able to grow our way out of this, period, until we bring our spending down. Our spending is mostly military and entitlements, and unless we do that, there is no solution, and I don't think we're going to do that. So we're going to have to inflate our way out of this debt. And there's talk of gold revaluation. You got this Russian guy, what's his name, Anton Kobayakov. He just came out a week ago and basically said the dollar, the Americans are going to do what they did in the 70s and in the 30s. They're going to devalue the dollar. They're going to shove everything into tokens and stable coins, and they're going to devalue stable coins. Instead of 1-to-1 ratio to the dollar, it's going to be 1 to a half a dollar. So the dollar's going to lose value overnight like it did in the 30s and the 70s, and then they're going to revalue with gold to tens of thousands. Is that possible? Is that what's going to happen? I don't know. But again, these are all desperate things happening now. The old system is objectively cracking. The consequences of the debt are obvious, and the symptoms that the jig is up are now obvious. This isn't even a gold bug argument anymore. This is something that the bond jocks that I know and the equity guys that I know and the currency and rate guys that I know are doing. And that's why gold is at all-time highs now. It's always getting the last silent laugh after being discredited for decades.
And you mentioned gold revaluation. This is something that you've written about, and a lot of people are talking about out there. And also stable coins. People have talked about how this is kind of maybe a backdoor way to introduce something similar to central bank digital currency, but CBDCs were not popular. So there's maybe a backdoor way to get that in. Your perspective on that, the probability of what would gold revaluation mean, and what would it mean if we went on some sort of stable coins instead of the US dollar or alongside it?
Well, look, it's like Michael Hartnett at B of A said, some type of gold revaluation is inevitable. We have no choice. And that is somewhat tied to tokenization. So we can talk about both. I mean, look, there's a lot there because we are so desperate, because the dollar is so clearly unloved and unwanted, and the U.S. Treasury is so clearly, objectively, quantifiably in decline. So what do we do if we can't get people to buy our U.S. Treasuries and they're now selling them? And certainly if we're pushing tariffs on them, they're going to be less likely to buy our Treasuries. So we need some kind of demand for the dollar. In the stable coin, which is neither stable nor a coin, because a stable coin is a blockchain asset with these Bitcoin-like properties, or it's got this obviously blockchain technology for transfer speed, but it's really centralized by an issuer with an audited promise that one stable coin, $1 equals 1 unit that's redeemable. But the issuer here are fintechs like Tether and Circle Internet, or they're commercial banks like JP Morgan. So you invest your dollar with one of those issuers and you get an e-dollar back. You get a stable coin back. By the way, the issuers, fintechs, Tether, etc., take your dollar and then they invest it in treasuries to back the stable coin. So they get the yield on the treasury. They get an arbitrage spread. They're making billions. I mean, literally, Tether is making more now than Citibank. I mean, they're just doing so well on this. But the user, the end user, what do? You get a stable coin. You get no yield. It's not stable because it's backed by a U.S. Treasury. We've seen how the U.S. Treasury, whether it's in 2023 or 2022, can have 3 sigma moves. It can be volatile. It's the worst performing asset in the last 5 years. So you get a stable coin that's not stable. It's backed by U.S. Treasury. It can be, and it is, highly programmable, highly trackable, and like those truckers we saw in Canada during COVID, it's just as seizable. So it's very controllable, but the story is it's modern, it's tech, it's fast, it's liquid. That's the good side. The bad side is it is central bank digital currency, but instead of being issued by a central bank, it's issued by private fintech companies or commercial banks. But it's just as trackable and it's just as controllable as a CBDC. So it's CBDC by another name. But more importantly, for this revaluation scheme that the Russians are, whether you believe the Russians or not, it does make sense what they're saying, because stablecoin is a new demand, it's a new sponge for those dollars. And right now, stablecoin is the 18th largest buyer of U.S. debt. So it's very helpful. It's a win-win for Tether. It's a win-win for the U.S. Treasury. But think about it, go to the second or third rate of thinking. I'm not saying this is going to happen, but it's a very strong likelihood. And it's been done before. Like I said, under FDR and under Nixon, we can devalue the dollar and revalue gold. And what the Russians are saying, and what this guy Anton is saying, does make sense if you're cynical. But honestly, even if you're a realist like Michael Harton at a B of A, it even makes sense to me that what you do is you put a ton of money into stable coins in this DLT technology, which Bitcoin kind of got us soft dripped and frog boiled to understand and get used to. It's a perfect psyop if you're doing this at ultimate cynic level, because you can fill a bunch of people into stable coins, and then the stable coin is very controllable. So then you can devalue the stable coin. And then you can basically, once you have a massive devaluation of the dollar to pay down some of your debts under the stablecoin mechanism, then you can revalue gold. And what the Russians are saying is the U.S. will revalue gold tens of thousands of dollars higher than it is today, which of course is great for me. I'm not just, for anyone who buys gold, that's great, but it's very, very bad for the U.S. dollar and anyone who measures their wealth in dollars. So I think that's the risk, and I think it could be done, and we'll see. But this idea of using gold and stablecoin to kind of reshuffle the deck chairs on the Titanic, debase the dollar significantly, then bring it with the gold valuation, because we've seen from Besant and the Fed papers that came out in August and July, they're slow dripping us, getting us ready for the possibility of a gold revaluation. And again, the two steps is to devalue the dollar and the stablecoin, then revalue gold by tens of thousands. We did this in the 30s. Gold went from 20 to 35. There was a massive revaluation of the dollar. And we did this in the 70s. We wiped out about 40% of the U.S. dollar's purchasing power within, the first 5 years. So we're as desperate now as we were under FDR, and certainly more so than we were under Nixon. So is this possible, this revaluation? And when I say revaluation, I'm not talking about revaluing our gold certificates at, $42.22 to spot. We're talking at a much higher level, creating a new floor in the gold price at tens of thousands of dollars higher. The problem with that too, and I'll end on this point, if we did revalue at a much higher level to bring debt to GDP down, it's effectively using gold for QE and debasing the dollar. Again, that's great for gold investors. That's brutal for anyone who doesn't have gold and owns dollars and measures their wealth in dollars. But even if we did that to solve our debt crisis at the expense of every citizen of the U.S. who doesn't own gold, every middle-class, hardworking American who can't afford a gram or an ounce of gold, they get clobbered. Nothing new there in the history of realpolitik. But then, as a country, if we revalue gold higher, do you think it's going to be any different on the SPYMEX in St. Petersburg or the Shanghai Exchange? In other words, the whole world's going to revalue gold. And then you have the larger question of who really does have the most gold. And this is what Kissinger warned about in the 70s, because he knew what I think we all kind of know, that the World Gold Council's report on U.S. gold holdings is woefully inadequate, and that China probably has significantly more gold than the U.S. So that if we did revalue gold and he who has the most gold wins, China is going to have massive leverage in this new system, this new disorder to come out of the former U.S. dollar-led, world reserve currency-led hegemony and supremacy of the last 50 years. That's going to be a radical change. And yeah, will help us get out of debt, but we'll lose a lot of international leverage. We'll lose a lot of credibility, and we'll lose a ton of influence vis-a-vis China and Russia. I mean, Russia isn't even listed on the World Gold Council for how much gold they have. It's probably a lot more than the U.S. too. So these are a lot of things we got to think about as we're looking at fantasy solutions, whether it's gold revaluation, whether it's stablecoin, whether it's tariffs. There's nothing that easy, and there's nothing that doesn't end up with the dollar becoming less and less respected and the U.S. becoming less and less powerful. And we are going to get that because it's the karma of decades of living beyond our means, monetizing our debt with mouse click money, and spending like teenagers with their father's credit card at the mall. I mean, we as a country we are not going to be able to blame this on Trump. It goes back 50, 60 years of every policymaker, every Fed chairman, every president, red, blue, or center, who has been living beyond their means, getting power, spending what we don't have, and then making that delta filled with money that's clicked out of nowhere ex nihilo. That is criminal drunk driving at the policymaking level. And of course, the citizens are going to suffer for this. This is nothing new.
It is interesting hearing you argue how really the outcome is inevitable, right? Whether you have, some people see gold revaluation maybe as the solution, but at the end of the day, as you mentioned, it's really just another way of doing quantitative easing, of creating more currency, and that's going to be inflationary. So what are your thoughts on people out there who aren't prepared yet for high inflation to come, the devaluation of the dollar and all that? What are your thoughts on, some common sense steps that people can take today?
Yeah, I think it's really important because, my business, our minimums are very high. Our clients are all high net worths, family offices, institutions. So why am I talking to you and why am I talking to the world? They're not going to be my clients. But Egon and I have always said it's not just, it's certainly not a fiduciary duty to us. It's a moral duty to try and educate, not just sell our book. And so we're saying you need to own gold as life insurance for openly dying currency. And so not so you can become a client of Von Greyerz, because 99% of the people listening don't meet our minimums. But that doesn't stop us from every week, every day writing about this and talking about this so that the average citizen, the average middle class American, of which I come from that world, lower middle class in the Midwest, I'm extremely conscious of this. So how do I get people to understand gold? And not look like I'm trying to make them a client or sell them a book or give them clickbait. It's a very important question. I think the first thing is, don't just take my word for it. Look at the math, not even the history. The history is kind of ornate and complex. You have to read a lot of books and look at different eras. Again, 18th century France, ancient Rome, Romania in the 90s, Weimar, Zimbabwe, the big examples. But there's literally tens of examples in these cycles of currency that's not money that gets debased because of extremely expensive governments that are over their skis in war debt or social contracts that they can't afford, and that they debase their currency to pay. And throughout history, all paper money, as Voltaire says, goes to zero. That's a long history with a lot of examples. But just look at math then, simple math, simple graphs. And if I had to say, there was a guy I used to know on Wall Street. He was at Goldman Sachs. He said, if you can't explain something with 3 graphs and a crayon, you're not doing anybody any service. So whether you're talking to very sophisticated people who work at, JP Morgan, you're talking to the guy on the street, whether you're a dental hygienist, a brain surgeon, a bricklayer, you can understand simple graphs. That's how I figured this out. And one simple graph is just to look at what the dollar has done in the last 54 years since we decoupled from gold versus gold. This is objective. It has lost 99%. So the dollar is this ice cube that you measure your wealth with. Whether it's in a checking account, whether it's in a portfolio, whether it's in a 401k, whether it's in your retirement account. You're measuring this in dollars, or if you're in Europe, you're measuring in euros, or if you're in Switzerland, you're measuring in francs. You're measuring it in paper money. And that paper money, that ice cube, is quantifiably, objectively melting versus gold, because gold's a better store of value. That should no longer be a gold bug selling your book clickbait story. That's just an objective fact. So you got to look at just the purchasing power of the major fiat money since 1971. All of them, from the Swiss franc to the euro to the dollar to the yen to the one, they're all losing money versus gold. Secondly, that is why central banks, and I'm not a fan of central banks. I'm not a fan of the BIS, the mother of all central banks. I'm certainly not a fan of the Fed, or even what's going on the comics. But what are the big guys in the room, the insiders? I'm not saying the smart guys, but what are the insiders doing? The ones who actually caused this problem and are now benefiting from it. They're stacking gold. Why? Because it's shiny? Because they need more dental work done or more wedding rings? No, they're stacking gold because they know what 99% of the retail audience has been misled about for the last 30 years by their advisors, that gold holds its value better than paper money. You won't get rich overnight, but you won't get gut punched by the invisible tax of inflation and currency debasement by owning a gram, an ounce, a bar of gold, whatever your income, if you can get some. And so it's because I don't trust government. I don't trust the honesty of these desperate policymakers who were drunk driving for years, have now crashed the currency into a wall and are blaming it on somebody else. That's classic political lack of accountability. But look at a graph of any currency versus gold in the last 50 years. Look at that ice cube melting. Look at the debt levels in the U.S. and in the world. Since 1997, when I came out of grad school, global debt was 30 trillion. Today, it's 300 trillion. That's an extraordinary movement in debt. Understand that as debt goes up, currencies go down. So you look at what, look what your dollar has done versus gold in the last 50 years. Look what debt has done in the last 30 years. Look what your currency is doing. These are objective things you can look at. Without reading any history books, just look at these simple indicators of what has happened to the debt levels and what has happened to your currency in terms of its purchasing power. Not relative to the yen or the peso, but in the U.S., what can it buy? So understand debt understand the debasement of your currency, and frankly, understand what inflation is. Inflation is just a term of art that we wankers throw around to look like we know Wall Street lingo. What you need to know about inflation is it's an invisible tax. You pay income tax, you pay sales tax, you also pay an inflation tax. So when your dollar is worth 10% less every 2 or 3 years, or 20% less every 4 years, and your wages aren't going up with that, that's simple math. You are losing money through the invisible tax of inflation. And here's the thing that you need to check on your own. The scale used to measure inflation is as bogus as a 42nd Street Rolex. I've said this many times. It is an open lie. It is an open secret. So you're not even being told the truth about what inflation is doing to you. You feel it when you go to Walmart. You feel it when you buy a car. A Ford 150 goes over $100,000 right now. That's ridiculous. Your wages came and buy a pickup truck in America, the American dream. It's a Range Rover price for a pickup truck now. Again, you feel the inflation. You feel it at the GW Bridge coming out of New York. You feel it in the cost of education and healthcare. But they're telling you, your government is telling you, now we're in the 2 to 3% range. That's just absolutely not true. So again, gold bug or not, please look at that. Look at it honestly. Look at what inflation is doing to you. You feel it. And by the way, when you go to your investment advisor, whether you're a millionaire or whether you're a teacher with a 401k, ask them what yield they're getting on their bond portfolio. And then ask them, if my yield is 3 to 4%, but actual inflation that I've just figured out what it means is 10%, that means aren't I losing 6% just on my bond investments? So ask about that, and ask your advisor, even if you're going to Goldman Sachs or JP Morgan or Citigroup or Morgan Stanley, the big and the best, talk to your private wealth manager and say, why is it for the last 25 years you haven't given me any gold allocations? Why did you downplay gold as a pawn shop asset that was too volatile when it's outperformed the S&P, when it's given 11 times its value in the last 25 years versus a bubble that's given me 7 times value? But the experts in the room were purposely telling you not to think about gold. So you got to ask these questions. They're math questions. They're quantifiable questions. The history gets a little wonkier, and then it gets political, and then your biases left or right can come in. But math is a stubborn thing. It's facts. Look at those facts, and then decide from yourself what opinion you want to have with those facts. I've been doing this for 25 years, and many of my clients are bankers and hedge fund managers who don't talk about gold out loud, but they're buying millions of dollars worth of it every day, because you have to understand the math of what inflation is doing, what currency debasement is doing. It's not that gold's going to go up 25% and make you richer. Gold's going to hold its purchasing power more than that paper currency you measure your wealth with. And that is objective. I think it's mathematical. And again, no, most of you listening are not going to be a client of mine, but I'm very interested in you understanding these things, because it's very unfair to me. It's always the middle class who get drafted. It's always the middle class who get shafted in an economic crisis. And it's especially dangerous for the middle class if they're older, if they're above 70 or 75, because people forget in markets that not every dip is a V-shaped recovery. Not every dip recovers in 2 months by the Fed. If you're over 70 and you're at the top of this market and we have a major mean reversion and you lose 30, 40, 50 or 50% or more, and you're older, you can't afford to wait 30 years like the Nikkei or 10 years like the Dow, the NASDAQ or the Dow after the 2000 crash to get that mean reversion back up. That's a very dangerous thing. And so these are the kind of things I think the man on the street isn't being told honestly, especially about market risk in the stock market, because, these markets, the advisors don't tell you how long these valleys can last. This is something, that Jeremy Grantham taught me years ago when he was still trading. This was 15 years before he retired. But, these market troughs, they last 5, 6, 7, 10, 11 years. And then they spend the rest of the time, recovering, and then they rip again. But if we're at a market top now, maybe not the top, and then we have a mean reversion that can't be just central bank supported like we had in 2000, like we had in the Great Financial Crisis, like we had in 72. These take years to recover. So that's another thing that people on the street have to ask their advisors. What if we don't get an instant mean reversion and I'm 75 years old and my 401k, which is worth X today, is worth X minus 40%? And then you tap on inflation to that. This is how the middle class is not being taught transparently about risk, not just currency risk, but about market risk, and certainly about inflation risk. This whole thing with the Fed talking about 3% inflation, 2% inflation, fighting inflation, it's an absolute farce. And again, I'm a well-educated guy from Wall Street. I should be selling the book of how efficient markets are and how smart bankers are and how intelligent your leadership is. But left or right, most of them don't know history or economics at all in the White House, again, regardless of the party. And these central bankers have made a Faustian deal with themselves, like Greenspan himself, who once understood gold but stopped talking about it once they were elected. But you're not getting the truth about what inflation is doing to your wealth right now. And you're not getting the truth about market risk right now. And I think that is something it bothers me to the core. Because, again, I come from the Midwest. I come from the middle class. And I know most people aren't getting this information from their advisors. They're just not. And they're certainly not getting it from the mainstream media, the financial media at all.
And if our viewers are interested in looking at your work, they can go to vg.gold. We'll put a link in the description of this video here where they'll be able to read all your articles that you post very regularly there and really on the same topics that we've discussed in this interview. So we really appreciate you taking the time, Matthew, today for our viewers. Did you want to share a little bit about what you write about?
Well, look, I think of myself almost as telling my son this other day. I love what I get to do. I mean, I spend a lot of time talking to clients, a lot of time building our business. But the best part of it is writing these articles and having these interviews, because that's a time to really be what I really want to be as a teacher. I look at each of these things as a lesson plan. Whether we're talking about the COMEX, whether we're talking about gold versus the dollar, whether we're talking about the dollar going up or down, whether we're talking about inflation and the inflation line. These are all like lesson plans. These are ways to get an education. It's a free education. You don't have to become a client to read these things or what Egon's writing. We've got, myself, Egon von Greyerz, Ronnie Sturfula, the author of the Gold Trust Report. He's an advisor. We've got Alistair McLeod. He's an advisor. We got Grant Williams. We got Grant Williams, Ronnie Sturfula, myself, Egon. These articles and insights are all free. And I think they're kind of the leaders in this space, not just gold, but market risk. And we're talking about all of the themes: stablecoin, Bitcoin, gold, the Fed, interest rates, inflation. All of that's free. And that's part of the education that I think anyone can have. And an education is power. And having an informed opinion is power. I think having an informed opinion is worth more than money. And it gives you confidence, and it gives you, I think, some context to handle these absurd times with a little more knowledge, and that's free, and we should all enjoy it. And so come to the website, read, and disagree with the stuff we have, but look at it. Andy Schechtman, obviously all of us are doing this to try and inform people, not just sell you gold. Again, most people won't be my client, but I really hope they read our material because they can learn stuff from this.
Fantastic. Well, Matthew, really appreciate your time today. As always, it's a crazy world out there, but we appreciate you kind of breaking down these complex topics. So thank you so much, and God bless.
Thank you, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for September 15th through September 22nd, 2025, while supplies last. This week, 1 10th-ounce gold maple leaves are just $37.50 over melt per coin. 1 ounce assorted silver bars are just $1.65 over spot per ounce. We also have near historic low premiums on pre-1933 gold. Call us for details. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.